Hi there. If you're anything like me and the 43% of our generation, then you've probably had questions like, what on earth is credit? What's my credit score? And why is it so complicated? Well, you can think of credit as a way to buy things now and pay for them later, almost like a financial magic trick. You get what you want today, but you'll have to pay a little extra as a fee to the lender or bank, which we call interest. Interest is a charge, typically a percentage of the loan amount paid over a period of time. It's the cost you pay for using someone else's money. There are two main types of interest. The first being simple interest. This type stays the same throughout the life of the loan and is commonly used in consumer loans like car loans or personal loans. The second being compound interest. This is a bit more complex. It not only charges interest on the original amount, but also on any interest that has been added over time. You end up paying interest on interest, which can significantly increase the total amount you pay. Compound interest is common in many loans, including mortgages. But this video is about credit, so let's get back to it. There are also two main kinds of credit. The one you're most likely thinking of is called personal credit. This is all about you and your personal stuff. Think of credit cards, auto loans, and home mortgages, buying a house. The other type is business credit. This is for companies and big ideas. This type of credit helps businesses grow, operate smoothly, buy supplies, and manage their cash flow. That's money coming in and out. And I'd like to take the time to say that liking, commenting, and subscribing helps us out tremendously. So please smash that like button, click that subscribe button, and let us know what your thoughts are in the comments down below. Now, you might be wondering about credit scores. What are they and why do they matter? A credit score is a 3-digit number that tells lenders and financial institutions how trustworthy you are when it comes to borrowing money. It's like a report card for your financial habits. Having a good credit score shows how responsible you are with borrowed money, and it's like a trust signal to lenders. A good credit score can mean lower interest rates and easier access to credit. It can save you money in the long run and make financial tools and opportunities more accessible and cost-effective. Naturally, you're probably wondering, well, where does my credit score come from? In the United States, credit scores are created by credit bureaus. They gather and aggregate information about your credit history and financial behaviors. The three major credit bureaus in the U.S. are Equifax, Experian, and TransUnion. They use the data collected to generate an overall credit score, which lenders use to assess your creditworthiness. Side note, there can be a small difference between your credit score with each credit bureau. It just depends on which model they use. Now, the final question I had was, what affects your credit score? The three most important factors in most credit scoring models, like FICO and Vantage, are credit utilization, length of credit history, and payment history. These factors carry the most weight. However, other factors do affect your credit score. Credit utilization is the amount of credit you're using compared to what's available to you. The best practice is to keep this number below 30%. To make it easier to understand, if you have a $10,000 credit limit, try to keep the balance below $3,000. Now, your length of credit history is just as it sounds. A look at exactly how long you've had different credit accounts and loans open. The way they calculate this is a bit odd, so if you want me to cover this in further detail, please leave a comment below. Finally, your payment history. This is the single most important factor in building your credit score. This tracks your ability to make payments on time. Accounts and collections, late and missed payments have the largest negative impact on your credit score. The best practice is to not miss a single payment. So don't be confused or scared about credit. It's like a trust rating for your financial responsibility. In the United States, it's important because a good credit score opens doors to financial opportunities. It can make buying a car, a house, renting an apartment, or getting a college loan way, way easier. Responsible credit use helps build a strong credit score, acting as your financial reputation, making future loans and better interest rates more accessible. If you found this video helpful, show some love by liking, sharing, and subscribing. Stay tuned for more videos where we'll explore how to spot financial traps, avoid common mistakes, set clear financial goals, and achieve a healthy financial outlook. Thanks for watching The Zoomer Finance.